Ever feel like the stock market has mood swings? One minute it's soaring, the next it's plummeting.
Like it can't make up its mind.
Exactly.
Yeah, well, that's the heart of what we're diving into today. Volatility clustering.
Okay, so let's break it down. When we say volatility clustering, what are we really talking about? Paint a picture for us.
Imagine a calm lake, right? Suddenly, a gust of wind whips through, creating all these choppy waves. Now, those waves don't just disappear instantly, they keep rolling for a while.
Okay, I can see that.
That's kind of like volatility clustering. Periods of big market moves, those are toppy waves, tend to be followed by more big moves. And then calm periods tend to stretch out. It's not just about the market being volatile right now, it's about that volatility having momentum, a tendency to stick around.
So it's like knowing whether the storm is brewing or passing.
You got it.
And you mentioned the VIX, the fear gauge. I get that it measures fear, but how does it actually do that?
The VIX is all about options on the S&P 500. Think of options as a kind of insurance policy for investors. When traders are worried about big market swings, they're willing to pay more for this insurance. The VIX tracks the price of this insurance. So a high VIX means traders are expecting a lot of action, a lot of potential price jumps. On the flip side, a low VIX tells us things are likely to stay calm.
So a high VIX is like everyone rushing to buy umbrellas because they think a storm's coming,
Uh-huh.
and a low VIX is like everyone lounging in the sun.
Precisely. And here's where it gets really interesting. The VIX itself shows this volatility clustering pattern.
Really?
Yeah, if you chart the VIX, over time you'll see clusters of high values followed by clusters of low values.
So the VIX isn't just telling us about fear, it's also showing us how fear itself clumps together, which gives us even more clues about how the market might move.
That's right. But here's something else to consider. What if we could measure just how strong this clustering effect is? When you take out the usual patterns of volatility, the clustering effect shrinks significantly.
That's a pretty strong sign that this isn't just random noise, right? There's a real pattern at play here.
Absolutely. It reinforces the idea that volatility clustering is a fundamental force in the market, and understanding it can give you a real edge.
Okay, so we've got this fascinating pattern, but what does it mean for someone who's not a Wall Street pro? Why should they care about volatility clustering, especially in relation to the VIX?
Well, for starters, it can make you a smarter investor.
Okay.
Knowing that periods of high volatility tend to cluster together can help you manage your portfolio's risk. Think of it like this. You wouldn't leave your windows open during a hurricane, right? Same idea here. When the VIX is spiking and volatility is high, you might want to consider reducing your exposure to risky assets, essentially taking shelter until the storm passes.
But how do we actually do that? I mean, how do we translate this knowledge of volatility clustering into real-world investment decisions?
There's a strategy called volatility targeting. It's all about adjusting your portfolio based on how wild or calm the market is feeling.
I'm intrigued. Walk us through how volatility targeting actually works.
The first and probably most important step is to figure out your own risk tolerance. You know, your own comfort zone with market ups and downs.
Gotcha. It's about knowing yourself as an investor.
Exactly. It's a very personal thing. You keep an eye on the VIX. If the VIX starts climbing above your comfort level, that's your cue to maybe reduce your exposure to those assets that are likely to get tossed around the most.
So it's like taking some chips off the table when the game gets a little too intense.
Now, on the flip side, if the VIX is suggesting a calmer market, you might consider increasing your exposure to potentially capture bigger gains.
Okay, so it's a dynamic dance between risk and reward guided by the VIX.
It definitely requires staying engaged with your portfolio, no doubt. But remember, the beauty of this strategy is that it's rooted in a real market phenomenon.
Right. We're tapping into that rhythm of the market we talked about earlier. Now, you mentioned that the VIX isn't the only way to measure volatility. Does volatility clustering show up in other parts of the market?
This isn't just an S&P 500 thing. Think about individual stocks. They have their own little personalities, their own volatility patterns.
So like some stocks are naturally more moody than others.
And guess what? Researchers have dug into this too. They looked at a bunch of individual stocks and found that clear clustering effect, that tendency for volatility to bunch up in every single one. It's like it's woven into the very fabric of how stocks move.
Wow. It's pretty amazing that something that seems so random actually has this underlying pattern.
It is, and the more you understand about these patterns, the better equipped you are to navigate the market's twists and turns.
All right, so we've talked about how to use this knowledge to our advantage. But let's flip the script for a second. If this volatility clustering thing is so predictable, why isn't everyone using it to get rich? What's the catch?
Ugh, the million-dollar question. There are a couple things to consider here. First, Even though volatility clustering is a real, measurable phenomenon, it doesn't mean we can predict the market perfectly.
So it's not like having a crystal ball.
Unfortunately, no. Markets are complex beasts influenced by countless factors. Volatility clustering gives us a valuable clue, a tell, as poker players would say, but it's not a guaranteed win.
Oh, okay. So it's like having an extra piece of information, an edge, but it's not a foolproof system.
And the second thing to remember is that not everyone has the same risk appetite or investment goals. Some people are perfectly content with a steady, low-risk approach, even if it means potentially missing out on some bigger gains.
Makes sense. It's all about finding what works best for you, your own investing personality.
Absolutely. But regardless of your investment style, understanding volatility clustering can help you make more informed decisions. This pattern, this tendency for volatility to clusters, shows up in all sorts of places. Bonds, currencies, commodities, you name it.
So this clustering idea is like a universal language of the markets, something that speaks to how prices move in general.
And the more volatile an asset tends to be, the more pronounced this clustering effect becomes. Think about things like oil or gold or even currencies in emerging markets. Those prices can swing wildly, and those swings tend to come in bunches.
Okay, that makes sense. The more dramatic the price moves, the bigger the waves, the more you'd notice those choppy periods. So are there any parts of the world where this clustering is especially intense?
Well, while the underlying principles seem to hold true everywhere, some research suggests that clustering might be even more pronounced in emerging markets compared to developed markets.
Which makes sense, right?
Yeah.
Those markets are often more sensitive to global events, political shifts, that kind of thing. More potential for things to get shaken up.
Precisely. It's
Mm.
all interconnected. But even though we see this pattern across the board, the big question remains, what's driving it? What's causing this clustering effect in the first place?
Yeah, that's the million-dollar question.
Yeah.
And I'm guessing there's no easy answer.
You're absolutely right. It's one of those fascinating mysteries of finance that keeps researchers busy. But while there's no single definitive explanation, there are some really compelling theories out there.
Okay, let's hear them. What are some of the leading contenders for explaining this clustering phenomenon?
One idea is that it's all about information, or more precisely, the arrival of new information. Think about it. When unexpected news hits the market, everyone scrambles to react, and that can trigger a surge in trading activity, which leads to bigger price swings.
So it's like a chain reaction.
Mhm.
One piece of news sets off a flurry of activity, and then another piece of news comes along, and it just keeps things churning.
Exactly. And remember how we talked about news often arriving in clusters? Earnings seasons, big economic announcements, those can create a perfect storm for volatility clustering.
So it's like the market is trying to digest all this new information at once, and it's getting a bit of indigestion, causing those price swings to bunch up.
That's a great way to put it. Now, another theory focuses on human behavior, the psychology of the markets. It suggests that this clustering might arise from what's called herding behavior.
Herding, like
Yeah.
sheep following each other. What does that have to do with the stock market?
Well, imagine you see a bunch of people running towards an exit. Even if you don't know why, you're probably going to start running too, right?
Yeah, I wouldn't want to be left behind. So are you saying that traders sometimes follow the crowd, even if they don't fully understand what's going on?
Exactly. And that instinct to follow the herd can amplify those price swings, making those periods of high volatility even more intense. It becomes a self-fulfilling prophecy where the fear of missing out or the fear of losing money drives even more volatility.
Wow, so the market's mood swings can be contagious. But you said there was another theory.
Yes. This one is about feedback trading. It's the idea that some investors simply react to price movements without necessarily thinking about the bigger picture. They buy when prices go up, thinking they'll go up even more, and they sell when prices fall, fearing further losses.
So instead of calming things down, they're actually adding fuel to the fire, making those swings even wilder.
It creates a kind of momentum effect where price movements in one direction tend to be followed by more movements in the same direction, leading to those extended periods of high or low volatility.
It's amazing how much psychology plays into all of this. It's not just about numbers and algorithms. It's about how people react, how fear and greed can drive those market swings.
Absolutely. And while we may never have one definitive answer to the why behind volatility clustering, all these different theories offer a fascinating glimpse into the complex forces that shape the financial world.
We've gone from the basics of volatility clustering to exploring its global reach and even the psychology behind it. What started as a seemingly random phenomenon has revealed itself to be this intricate, fascinating pattern that affects markets around the world.
It really is a testament to how much we still don't know about the markets. But the beauty is that every new discovery, every new insight brings us one step closer to understanding how this complex system works.
And that understanding can empower us to make smarter decisions, whether we're long-term investors or active traders. It reminds us that even though markets can seem chaotic, there are underlying patterns that we can learn to recognize and even use to our advantage.
And that's what makes this journey so exciting. The more we learn, the better equipped we are to navigate the market's ever-changing landscape.
Thank you for joining us on this adventure, and remember, risk happens fast, think different.